China's strategic maneuvers in 2025, including renouncing new special and differential treatment at the WTO, while expanding Belt and Road partnerships and BRICS non-dollar settlement mechanisms, are reshaping international trade norms amid U.S. protectionist escalations. This shift matters profoundly now, as Beijing positions itself to influence multilateral reforms and regional frameworks like RCEP, potentially fragmenting established rules-based systems. The consequences extend to altered supply chains, elevated transaction costs, and diminished Western leverage in global commerce. Tension arises from the interplay of unilateral tariffs and alternative architectures, where Beijing's initiatives could accelerate multipolar trade alignments. Hidden within these developments lie risks of retaliatory spirals and disrupted alliances, fostering an environment where traditional governance structures face erosion and stakeholders confront recalibrated economic interdependencies. As the multilateral trading system navigates persistent challenges and reform imperatives on December 26, 2025, China's announcement in September 2025 to forego seeking new special and differential treatment in ongoing and future World Trade Organization negotiations represents a pivotal strategic repositioning that warrants close scrutiny for its implications on global trade governance and economic interdependencies. Articulated by Premier Li Qiang during a high-level meeting on the Global Development Initiative held on the sidelines of the United Nations General Assembly in New York on September 23, 2025, this commitment specifies that China, while retaining its self-designated developing country status within the WTO framework, will no longer pursue additional flexibilities or exemptions available under special and differential treatment provisions in current or prospective agreements. This voluntary concession, communicated formally through a WTO General Council document dated September 24, 2025, and welcomed by Director General Ngozi Okonjo-Iweala as a pivotal moment facilitating reform, addresses long-standing criticisms from advanced economies regarding the application of such provisions by major emerging powers. The announcement's timing and framing underscore a calculated effort to break persistent deadlocks in WTO negotiations, particularly those concerning industrial subsidies, state-owned enterprises, and dispute settlement mechanisms, which have been stalled partly due to disagreements over differential obligations for developing members. By relinquishing claims to new special and differential treatment, encompassing extended implementation periods, reduced commitment levels, and technical assistance preferences, China aligns with economic logic aimed at unblocking progress on modernizing rules to reflect contemporary realities of global value chains and digital trade. This move facilitates potential advancements in areas long contested, such as transparency requirements for subsidy notifications and disciplines on forced technology transfers, enabling broader consensus building ahead of the anticipated ministerial conference in 2026. Geopolitically, the decision positions Beijing as a proactive stakeholder in multilateral reform, countering narratives of obstructionism propagated by the United States and European Union, which have argued that China's utilization of developing country flexibilities distorts competitive neutrality given its status as the world's second-largest economy. The announcement diffuses a key point of contention that has underpinned U.S. positions blocking appellate body appointments and broader reform packages, potentially easing pathways for restoring dispute settlement functionality. By emphasizing its continued identity as a responsible major developing country and commitment to defending legitimate interests of other developing members, China seeks to maintain solidarity within the Global South while projecting leadership in upholding the rules-based system against unilateral tendencies. Market responses to this development have exhibited cautious restraint, with limited immediate volatility in equity indices or currency pairs, reflecting the announcement's prospective nature rather than retroactive application to existing agreements. Commodity and manufacturing sectors exposed to Chinese supply chains registered muted adjustments, as the concession does not alter entrenched obligations from China's 2001 accession protocol, which already imposed stringent WTO plus commitments limiting subsidy recourse. Nonetheless, sentiment in trade-sensitive assets displayed subtle optimism, with emerging market bond spreads narrowing marginally in anticipation of de-escalated tensions, potentially averting broader tariff escalations. Underlying consequences of this positional shift include the preservation of China's existing special and differential treatment rights under prior accords, ensuring continuity in policy space for domestic industrial support mechanisms that have underpinned export competitiveness. This retention mitigates abrupt disruptions to state-led development models while signaling openness to negotiated reciprocity in future plurilaterals or critical minerals frameworks. The move also reinforces China's narrative as a defender of multilateralism, contrasting with perceived U.S. retreat from institutional leadership, thereby enhancing soft power projections in forums like the G20 and UN. Concealed perils arise from potential alienation of developing country coalitions, where members like India and South Africa have historically relied on unified positions to preserve flexibilities, risking fragmented bargaining that dilutes collective leverage against advanced economy demands for reciprocal concessions. U.S. or EU insistence on retroactive application or escalated commitments, beyond the voluntary foregoing of new privileges, could provoke defensive alignments, prolonging impasses and heightening uncertainties in dispute resolution. Coalition fragmentation may undermine advancement toward unified outcomes on e-commerce or environmental goods, perpetuating paralysis in an organization already strained by appellate body dysfunction since 2019. This strategic concession illuminates broader vulnerabilities in global trade governance, where voluntary adjustments by major players intersect with entrenched asymmetries, fostering environments where progress depends on reciprocal goodwill amid protectionist undercurrents. China's clarification through mission statements that the decision constitutes no precedent for other developing members preserves solidarity rhetoric, yet exposes divergences in capacity and priorities that could splinter G77+ China coordination. The announcement's integration with Global Development Initiative pledges, including continued funding for least developed country integration, reinforces Beijing's role as a provider of public goods, contrasting with budget constraints in traditional donors. Economically, the foregoing of new special and differential treatment facilitates potential liberalization in services and investment chapters, where China's commitments could expand market access for foreign providers, altering competitive dynamics in sectors like finance and telecommunications. This alignment supports domestic imperatives for high-quality opening, as articulated in recent policy documents emphasizing dual circulation strategies that balance external engagement with internal resilience. Geopolitically, the move counters isolation risks in multilateral settings, where WTO reform discussions have increasingly bypassed paralyzed consensus mechanisms through plurilateral advances like the Investment Facilitation for Development Agreement. By removing a frequent blockage cited in U.S. communications, China enhances prospects for inclusive outcomes, yet invites scrutiny on implementation sincerity given persistent domestic practices in subsidy transparency and intellectual property enforcement. Market caution persists amid recognition that the concession addresses procedural rather than substantive distortions, with industrial overcapacity concerns, particularly in electric vehicles and renewables, remaining unresolved absent binding disciplines. Volatility in related equities reflects hedging against protracted negotiations, where failure to capitalize on this opening could revert to unilateral measures amplifying trade diversion costs estimated at 1 to 2% of global GDP in fragmented scenarios. Hidden risks encompass retaliatory dynamics if perceived as insufficient by critics, prompting escalated unilateral actions that bypass WTO channels, further eroding institutional authority. Alienated developing members may pivot toward regional alternatives like the African Continental Free Trade Area or expanded RCEP, accelerating bloc formation that elevates transaction frictions across divergent regulatory regimes. This unfolding repositioning underscores the precarious equilibrium in multilateral trade governance, where voluntary concessions intersect with power asymmetries to shape reform trajectories. China's emphasis on development-centered approaches in subsequent General Council interventions reaffirms commitment to inclusive outcomes, yet exposes tensions in balancing national priorities with collective advancement. The announcement's integration with broader global development initiative frameworks, pledging enhanced support for least developed countries, positions China as a bridge between north-south divides, potentially unlocking stalled dossiers on fisheries subsidies or agriculture. Market adaptations, with limited immediate repricing, anticipate gradual de-escalation, enabling supply chain stabilization amid rerouting pressures from prior restrictions. Concealed vulnerabilities in coalition dynamics risk protracted deadlocks if solidarity erodes, heightening uncertainties. For exporters navigating overlapping regimes, banking and investment flows, sensitive to regulatory predictability, confront recalibrated risks as negotiations evolve, with potential for credit adjustments in trade finance portfolios exposed to contested sectors. As reform discussions intensify toward 2026 milestones, this concession illuminates pathways for renewed multilateral efficacy, yet demands reciprocal flexibility to avert fragmentation that imposes enduring costs on interconnected economies. Intelligence monitoring of negotiation texts and coalition alignments remains critical to assess trajectory sustainability in a landscape of contested governance. As the global trade landscape confronts mounting fragmentation and realignment pressures on December 26, 2025, China's expansion of the Belt and Road Initiative, BRI, and complementary regional frameworks is profoundly reshaping international trade flows, redirecting supply chains, securing strategic resource access, and altering competitive dynamics across continents. In the first half of 2025, BRI engagements reached record levels, with total deals amounting to approximately $123 billion, comprising $66.2 billion in construction contracts and $57.1 billion in investments, surpassing previous annual highs and signaling a resurgence focused on green energy, digital infrastructure, critical minerals, and port developments. This expansion, emphasizing high-quality and sustainable projects, has seen energy sector engagements hit $44 billion in H1 alone, the greenest on record since the initiative's 2013 inception, with $9.7 billion directed toward wind, solar, and waste-to-energy installations yielding 11.9 GW of new capacity. Investments in metals and mining soared to $24.9 billion, primarily in critical minerals processing and extraction, underscoring Beijing's drive to dominate supply chains for electric vehicles, batteries, and renewable technologies amid global decarbonization demands. Complementing BRI efforts, the Regional Comprehensive Economic Partnership, RCEP, continues to harmonize tariffs and rules of origin among its 15 members, boosting intra-regional trade volumes that already constitute around 50% of participants' total commerce. Tariff reductions progressing toward 90% coverage by the mid-2030s have facilitated deeper integration, with intra-RCEP flows exhibiting resilience and projected growth supporting China's export diversification. Unilateral measures, such as the extension of zero-tariff treatment to nearly all African nations with diplomatic ties, announced in mid-2025 and expanding prior least developed country preferences, further amplify market access for commodities and value-added goods from the continent. Manufacturing foreign direct investment liberalization, fully removing restrictions in the sector under updated negative lists effective 2025, has encouraged inbound capital into high-tech and green production, aligning with domestic overcapacity redirection and global value chain embedding. Geopolitically, this multifaceted expansion advances alternative trade architectures, enhancing Beijing's influence in the global south at a time when traditional multilateral leadership appears diminished amid unilateral actions elsewhere. By prioritizing digital connectivity through fiber optics, data centers, and 5G corridors, and green transitions in partner economies, China positions itself as a provider of public goods in underserved regions, contrasting with competing initiatives that struggle with scale and delivery. Investments in strategic ports, such as those in Pakistan, Sri Lanka, and emerging African hubs, secure maritime nodes that facilitate rerouted flows, insulating against chokepoint vulnerabilities while fostering dependency on Chinese-operated logistics. Market reactions manifest in rerouted supply chains, where Chinese export shares have risen in BRI corridors despite external tariffs, elevating freight premiums by 20 to 30% in contested routes due to capacity reallocations and insurance adjustments. Trade diversion effects are pronounced, with intra-Asian and Africa-China volumes accelerating while Western routes experience relative stagnation, reflecting economic interdependencies that prioritize proximity and preferential access. Underlying consequences include entrenched debt dependencies in recipient nations, where resource-backed financing, dominant in mining and energy deals, ties repayments to commodity outputs, exposing borrowers to price volatility and fiscal strains as repayments peak in vulnerable economies. Trade diversion from established routes disrupts incumbent suppliers, compressing margins in competing exporters and prompting defensive barriers. Concealed perils encompass overcapacity exports flooding global markets, particularly in renewables and electric vehicles where domestic production exceeds absorption, risking retaliatory measures from affected economies that escalate into broader protectionism. Liquidity strains in vulnerable borrowers, compounded by maturing obligations and currency mismatches, amplify regional instabilities, potentially precipitating balance of payments pressures and sovereign stress indicators. These dynamics, intertwined with fragmented governance, heighten systemic vulnerabilities where abrupt policy shifts or demand slumps cascade through interconnected chains, constraining growth and inflating adjustment costs in reliant sectors. This expansion's trajectory in 2025, with record H1 engagements transitioning towards stabilized yet strategic outflows, illuminates a deliberate reshaping of trade flows that exploits interdependencies for resource security and market penetration. Green emphases, while addressing sustainability critiques, coexist with fossil and mining surges, reflecting pragmatic adaptation to partner needs and domestic imperatives. RCEP's harmonization reinforces intra-regional resilience, cushioning external shocks while amplifying China's centrality in Asian value chains. Geopolitical advancements through BRI's small and beautiful pivot, focusing on scalable digital and renewable projects, embed influence in critical nodes, from Chankay port linkages to African mineral corridors, fostering ecosystems dependent on Chinese standards and financing. Unilateral African tariff removals, extending zero-duty access, stimulate commodity inflows, yet risk reinforcing primary export patterns absent complementary industrialization support. Market rerouting elevates premiums in alternative lanes, with Cape routes and Arctic passages gaining utilization amid traditional choke point concerns, transmitting cost impulses to end consumers. Overcapacity spillovers, evident in solar and battery sectors where Chinese dominance exceeds 80% of global capacity, provoke defensive responses that fragment standards and elevate compliance burdens. Debt dependencies, with cumulative BRI lending surpassing $1 trillion since inception, manifest in repayment peaks straining fiscal buffers in low-income partners, where resource-backed structures tie sovereignty to output volatility. Trade diversion undermines multilateral cohesion, as preferential blocs proliferate divergent regulations, imposing adaptation costs on non-aligned exporters. Concealed liquidity strains in borrowers navigating elevated servicing amid commodity cycles, risk contagion through banking exposures to project finance, amplifying vulnerabilities in regional systems. Retaliatory barriers, triggered by market flooding, escalate into spirals that constrain interconnected demand, perpetuating subdued global growth forecasts. This reshaping of trade flows, driven by integrated BRI-RCEP strategies, underscores a transition toward resilient yet fragmented architectures, where economic interdependencies serve geopolitical objectives while imposing adjustment burdens on global stakeholders. Intelligence imperatives prioritize tracking investment compositions, debt trajectories, and flow diversions, as these elements delineate enduring realignments in contested trade domains with systemic implications for stability and prosperity. As the global financial system navigates an era of heightened fragmentation and strategic competition, on December 26, 2025, BRICS initiatives have markedly intensified efforts to advance non-dollar settlements and alternative payment mechanisms, with intra-bloc trade increasingly conducted in local currencies and exploratory platforms incorporating blockchain technologies for cross-border transactions. This acceleration, observed throughout 2025, includes expanded bilateral swap lines, commodity invoicing shifts away from dollar denomination, and pilot programs for decentralized messaging systems, collectively aligning with geopolitical objectives to reduce exposure to sanctions and external financial pressures. The year has seen significant progress in local currency utilization within the expanded BRICS framework, where reports indicate that approximately 50% of intrablock transactions now occur in non-dollar denominations, particularly bolstered by yuan-ruble and rupee-based corridors, though comprehensive operational unification remains in developmental phases. Initiatives such as the BRICS Cross-Border Payments Initiative, reaffirmed in summit declarations, emphasize strengthening correspondent banking networks and enabling settlements in national currencies, with technical reports presented at the Rio de Janeiro summit in July 2025 outlining preferences for interoperable domestic systems rather than a singular platform. Blockchain exploration features prominently in these efforts, with discussions evolving around decentralized architectures for messaging and settlement, including proposals for token-based units of account pegged to commodity baskets or national currencies to facilitate efficient intrablock flows without dominant vehicle currency reliance. Pilot demonstrations and feasibility studies, building on national infrastructures like China's cross-border interbank payment system and Russia's system for transfer of financial messages, aim to integrate digital tools for transparency and reduced intermediation costs, though full deployment timelines extend into 2026 or beyond. Geopolitically, this push aligns with efforts to mitigate sanctions risks, enabling resilient trade channels for members facing restrictions while fostering autonomy in commodity pricing, particularly energy and metals where non-dollar invoicing has gained traction. Expanded swap arrangements and contingency reserve pools provide liquidity buffers in local denominations, insulating participants from dollar funding squeezes observed in prior crises. Economically, these mechanisms lower transaction costs within the bloc by eliminating conversion fees and hedging requirements, enhancing competitiveness for exporters and importers operating in aligned corridors. Market behavior reflects increased positioning in emerging currency pairs and related forwards, with hedging volumes rising as participants navigate transitional volatilities. Concealed perils include settlement imbalances absent a universally accepted vehicle currency, where multilateral netting challenges could accumulate exposures and amplify adjustment pressures during asymmetric shocks. Potential retaliatory measures from external actors, including tariff escalations or network exclusions, risk disrupting flows and prompting defensive alignments that escalate fragmentation. Banking exposures to currency mismatches trigger credit adjustments as institutions recalibrate risk-weighted assets amid shifting collateral preferences, potentially constraining lending in trade finance segments critical to bloc integration. As these mechanisms mature through pilots and interoperability enhancements, they underscore vulnerabilities in dollar-centric systems, risking fragmented liquidity pools and heightened volatility in global payments where interconnected dependencies transmit disruptions rapidly. This intensification in 2025, following summit commitments to pragmatic local currency advancement over unified instruments, illuminates a pragmatic pathway toward reduced dollar intermediation, with blockchain elements providing technical foundations for decentralized efficiency. Intrablock progress, while uneven across pairs, demonstrates operational viability in bilateral contexts, supporting commodity trade resilience. Geopolitical alignment drives this momentum, where sanctions experiences catalyze infrastructure investments that parallel existing networks, offering redundancy without immediate confrontation. Economic benefits accrue through cost compression and risk mitigation, yet require coordinated clearing to manage multilateral imbalances effectively. Market caution, evident in diversified exposures and premium embedded pricing, anticipates transitional frictions as adoption scales. Hidden risks of imbalance accumulation and retaliatory spirals loom, with banking recalibrations imposing credit constraints that dampen expansion. The maturing of these alternatives highlights dollar system fragilities, where fragmented channels elevate volatility and constrain interconnected demand, catalyzing cautious realignments in reserve and trade architectures. This evolving framework, grounded in incremental interoperability, positions BRICS as a laboratory for multipolar payments, with implications for liquidity provision and crisis response in contested environments. Intelligence monitoring of pilot outcomes and settlement volumes remains essential to gauge trajectory sustainability amid external pressures. The acceleration underscores a deliberate pivot toward resilient mechanisms, imposing adjustment burdens while enhancing strategic autonomy in global finance. As the multilateral trading system contends with entrenched paralysis and escalating unilateralism, on December 26, 2025, global trade fragmentation has accelerated markedly amid the interplay of U.S. tariff escalations under the second Trump administration and China's strategic multilateral repositioning. Fostering the emergence of divergent trade blocs centered around frameworks such as the Regional Comprehensive Economic Partnership, RCEP, and expanded BRICS mechanisms, while the World Trade Organization (WTO) remains sidelined by stalled reforms. This realignment, evident in 2025's trade data and policy actions, elevates transaction costs through divergent regulatory standards and rerouting imperatives, reshaping established flows and imposing structural adjustments on interconnected economies. U.S. tariff actions in 2025 have constituted a broad escalation, commencing with executive orders in early February invoking national emergency authorities to impose baseline reciprocal duties, progressing through phased hikes that reached peaks of 125% on select Chinese high-tech and green energy products by April, with subsequent modifications yielding a negotiated reduction to 10% reciprocal rates extended through November 2026 following high-level engagements. These measures, encompassing threats of 60% on Chinese imports, 25% on Canada and Mexico, and up to 100% on BRICS origin goods, have prompted retaliatory responses, including Chinese countermeasures up to 125% on U.S. agricultural and industrial items, and widespread trade diversion, contributing to projected merchandise volume contractions of 0.2 to 1.5% globally per WTO revisions. China's repositioning, including the September 2025 commitment to forego new special and differential treatment in WTO negotiations while retaining existing privileges, facilitates potential deadlock resolution on subsidies and dispute settlement, yet occurs alongside deepened regional integration via RCEP tariff harmonization, now advancing toward 90% coverage, and unilateral concessions, such as zero-duty extensions for African exports. These efforts, complemented by Belt and Road investments exceeding $123 billion in the first half of 2025, focused on digital and green corridors, redirect flows toward Asia-Pacific and Global South partners, amplifying intra-RCEP volumes resilient to external shocks. Geopolitically, this interplay empowers alternative governance models, with RCEP and BRICS frameworks gaining operational traction against WTO dysfunction, its appellate body remaining inoperative since 2019 and reform prospects deferred beyond the March 2026 ministerial conference. BRICS advancements in local currency settlements, reaching significant intrabloc shares, and exploratory payment alternatives diminish unified enforcement of multilateral norms, fostering bloc-specific standards that challenge most favored nation principles. Market caution manifests in accelerated supply chain diversification, with firms incurring rerouting premiums of 20 to 30% in alternative lanes and nearshoring investments projected to relocate substantial manufacturing footprints, elevating compliance and adaptation burdens across sectors. Commodity pricing embeds heightened geopolitical premia, with freight and insurance adjustments transmitting inflationary impulses estimated at 1 to 2 percentage points in affected corridors. Concealed perils include retaliatory cycles that amplify inflation through cascading duties, liquidity squeezes in banking systems exposed to trade finance portfolios vulnerable to volume contractions, and abrupt capital outflows from contested corridors precipitating crises in emerging markets with elevated external debt servicing ratios. These dynamics risk broader instability, constraining interconnected growth through subdued demand and inefficient reallocations, catalyzing shifts toward regional architectures that prioritize resilience over optimization. This evolving fragmentation, driven by unilateral escalations intersecting with preferential bloc consolidation, underscores a departure from hyperglobalization toward balkanized flows, imposing enduring costs on efficiency and welfare. RCEP's integration, cushioning members against external tariffs, contrasts with WTO sidelining, where reform consultations yield incremental procedural gains absent substantive breakthroughs. U.S. actions, invoking reciprocal and security rationales, provoke countermeasures that perpetuate diversion, with retaliations from China and others compressing U.S. export competitiveness in agriculture and machinery. BRICS coordination, condemning arbitrary measures while advancing settlement alternatives, reinforces multipolar tendencies that dilute traditional enforcement leverage. Market adaptations reflect caution through premium-embedded pricing and hedging intensification, with volatility in trade-sensitive equities signaling adjustment frictions. Supply chain rerouting, while enhancing redundancy, elevates operational expenditures estimated at trillions cumulatively over transition periods. Concealed banking vulnerabilities with exposures to fragmented flows triggering provisioning increases, risk credit contractions amplifying downturns in reliant sectors. Retaliatory spirals, fueled by perceived asymmetries, perpetuate inflation above targets in open economies. Liquidity strains in emerging borrowers navigating repayment peaks amid diversion heighten sovereign stress probabilities, with contagion potential through interconnected claims. This acceleration risks precipitating interconnected crises, where abrupt policy shifts cascade through vulnerable nodes, undermining stability and catalyzing inefficient yet resilient architectures that impose long-term growth penalties. As unilateralism intersects with preferential integration, fragmentation catalyzes realignments constraining multilateral efficacy and elevating adjustment burdens on global stakeholders. Intelligence imperatives prioritize tracking block V. Volumes, regulatory divergences, and financial exposures, as these delineate trajectories in contested trade domains with systemic ramifications for prosperity and equilibrium. The interplay, while yielding short-term block gains, perpetuates volatility that demands vigilant recalibration to navigate emergent realities.